I want to read you one sentence that came out of a Vanguard economist's mouth this morning. One sentence that tells you more about where we are right now than anything you're going to see on CNBC today. Joe Davis, global chief economist at Vanguard, one of the largest retirement fund managers on the planet, was asked about the Fed's decision last week to hold interest rates steady. Here's what he said. The Fed's decision is really emblematic of the tensions in the U.S. economy and for the financial markets. He cited cross currents from high and rising oil prices, which is not originally part of our forecast, nor the Federal Reserve's, which is going to push inflation up. And then he said this, the biggest wild card really is the price of oil, which is by far the most important indicator. I only would get concerned if we see oil prices breach $150 a barrel and stay there for a little bit. That is not our baseline, but it is something that would lead to markedly weaker economic activity, much higher inflation, and that would put the Federal Reserve in even a trickier spot than they are presently in. Let me say that again. $150 a barrel oil would lead to markedly weaker economic activity, much higher inflation, and put the Fed in an even trickier spot than it already is in. This is not a fringe analyst talking. That is the chief economist of Vanguard. Now, if you don't know who Vanguard is, here's the context. Vanguard manages roughly $10 trillion in assets, and the majority of that is in retirement accounts, 401k plans, IRAs, target date funds, pension assets. And when Vanguard's global chief economist speaks about the economy and interest rates, he is speaking on behalf of the institution that quite literally manages the retirement savings of tens of millions of Americans. He doesn't say things like markedly weaker economic activity and much higher inflation casually. He says them because the data supports it. And he said them this morning. Now let's talk about where oil actually is right now and how far it is from that $150 a barrel threshold. As of this morning, Brent crude is trading in the low to mid 90s. One firm suggested Brent could run to at least $120 over the next month. And in a worst case scenario, the same firm said oil could eventually test $200. That's not a prediction, it's a scenario. But here's the reality. The distance between 90 and 150 is not as wide as it sounds in an environment where the Strait of Hormuz remains effectively blockaded and a ceasefire is nowhere in sight. 6 weeks ago, oil was at $60. Now it's at $90. The same pace of increase for another 6 weeks takes us very close to that Vanguard threshold. I'm not saying that'll happen. I'm saying the math deserves your full attention. Let me translate markedly weaker economic activity into plain retirement planning language. It means companies earn less, which means stocks struggle, which means portfolio values drop. It means interest rates stay high or potentially go higher, which pressures bond prices. It means the consumer pulls back dramatically, which feeds back into corporate earnings. And it means the Federal Reserve, which is already, in Davis's own words, in a tricky spot right now. And that gets pushed into a corner where every possible move makes something worse. For a retiree or near retiree, this environment is not just uncomfortable, it's structurally dangerous. Not because it's the end of the world, but because timing matters in retirement in a way it simply doesn't when you're still accumulating. When you're drawing income from a portfolio in a markedly weaker environment, drawing more to cover higher costs while the portfolio simultaneously declines, the damage compounds in a way that takes years to recover from, if it recovers at all. Now, here's the honest message that most financial advisors won't say clearly or loudly enough. The $150 threshold that Vanguard's chief economist just outlined is not an abstract theoretical number. It is a specific, data-driven line in the sand, identified by one of the most credible research teams in the retirement industry, beyond which the economic damage becomes meaningfully more severe. Right now we're at $90. We were at $60 6 weeks ago. The question every person in or near retirement should be asking their advisor this week is simple. What does our retirement plan look like if oil hits 120? What does it look like if it hits 150? What about 200? How does my income hold up? How does my withdrawal rate change? How does my cost of living change? If your advisor doesn't have clear, honest answers to those questions, you don't have a stress-tested plan. You have an optimistic one. The chief economist of Vanguard just told the world what his concern threshold is. That's not fear-mongering. That's exactly the kind of data-anchored guidance that retirement planning should be built on. Your plan should be able to answer the same questions Vanguard is asking internally. For your specific situation, your specific income structure, your specific timeline. I'm Robert Beck. This is the work I do. If you want to know what your plan looks like at $120 or $150 a barrel of oil, before that becomes the headline instead of the forecast, the link is below. Subscribe, because the people who protect their retirements are the ones who take the data seriously before it becomes an emergency.